Good afternoon, everybody. My name is Mike Maharrey. I'm the editor at SchiffGold.com/news. That's not what I meant to say. I meant to say I am the editor at SchiffGold News, which you can find at SchiffGold.com/news. I do most of the content over there. And today I wanted to talk a little bit about the choice that the Federal Reserve is going to have to make at some point down the road. It's interesting. The stock market is down a little bit today. It was down about 75 points when I looked right before I started recording. But on the week, the Dow is up about 800 points. That's over the last 4 days, which is really interesting. It shows that there's still this disconnect between the stock market and the actual economy, because we know the actual economy is a wreck, right? There's no question about that. Excuse me. We got the latest unemployment numbers today. Another 2.4 million Americans filed for unemployment last week. I think that was the correct number. So we're now up to I've lost track. It's like 38.7 million people that have just in the last 9 weeks have filed for unemployment. And so we have this situation. We have horrible economic data coming down the pike virtually every day. And yet we still have the stock market rallying. Well, why is that? The reason that is often given is that there is optimism that we may be coming out of this coronavirus economic shutdown. And earlier in the week, we actually got a big boost in the stock market because there was some promise apparently for a coronavirus vaccine. But that's just weird to me because it makes this assumption that all of the problems hinge on reopening the economy, that the economy is just going to start right back up when you flip that switch and everything gets going again. And of course, that's ridiculous. I can't imagine how anybody thinks that's going to happen. I mean, just last week, when we should be seeing some improvement, states are starting to open up. We had another 2.4 plus million people file for unemployment. So it's pretty clear that the economy is not, getting ready to roll down the hill like a rock into greatness and wonderfulness. So, I think that's it's a little bit foolishness. I think the real reason that we're seeing that this stock market rally is because the Fed is continuing to support the market with promise of stimulus. And Colin Powell, boy, that went back a little ways, didn't it? Jerome Powell was on 60 Minutes on Sunday and assured us that the Fed's got our back. In fact, he said that there really is no limit to what the Fed can do. Now, as Peter Schiff pointed out in his podcast a couple of days ago, of course, there's a limit to what the Federal Reserve can do. Really, all the Fed can do is print money. And that's what it's doing. When you look at the actual numbers, the amount of money that is being produced out of thin air and injected into the economy right now is staggering, unprecedented. We've never seen the money supply grow as fast as it has over the last several weeks. So the Fed is doing everything that it can, and that's printing money, and it's promising that it will continue to do so to support the economy. We're going to continue to get this extraordinary monetary policy. I think it's highly likely we're going to get more fiscal policy from Congress, whether it's another stimulus package or what form it takes, I'm not sure, but I think we can expect more borrowing and spending. So that's really what's supporting the stock market right now. It's the promise of stimulus. It is Federal Reserve money that is propping up the stock market. And that was actually the case before coronavirus. And I think that's really the key thing that we have to understand. That's something that I've been harping on for weeks on my podcast, the Friday Gold Wrap, which you can find over at SchiffGold.com/news. I've been writing about it over on the SchiffGold website. This monetary policy goes all the way back to 2008. This is nothing new. The Fed has been propping up and blowing up the stock market for well over a decade. And we're now seeing this same policy on hyperdrive. Okay, so we've just upped the ante. We're doing it bigger. As Trump would say, it's bigly. We've got bigly monetary policy now, and that's what's propping everything up. I think eventually the Fed is going to be faced with a very difficult decision. And no matter what choice it makes, it's really bad news for the economy. So I want to look ahead a little bit. And for this thought experiment, I want to actually accept the idea that once the economy is opened up completely, let's say we do get a coronavirus vaccine. Let's assume that once that happens, the economy really opens up again and things start to hum along. And let's just say, for the sake of argument, that the economy actually starts to recover in real terms, that the unemployment numbers quickly drop, that productivity increases, that economic growth starts again. And let's just pretend like that's what's going to happen. It's for this thought experiment. I don't think that's what's going to happen. I think that we're in for a long period of slow economic growth, of recession. So, I'm being overly optimistic, but let's just pretend like we are accepting what the mainstream has been telling us, and then we're going to get this quick recovery. And I think it is possible in the near term. Let's say we did get a vaccine. I think we would see a jump in GDP. We would see a jump in the economy, and that it's only natural because people would start to go back to work. But I think that ultimately we're in for a long period of recession. But for our thought experiment, we're pretending like the economy gets going again. And so we're rolling along and we're seeing GDP increase. And what is going to happen next? So the Federal Reserve, in the the way this is supposed to work, is the Fed does this on an emergency basis. It provides stimulus, and then once the economy begins to recover, it takes the stimulus away. So ostensibly, what should happen is we should see interest rates gradually go back and approach something closer to normal. We should see the Fed's balance sheet begin to shrink, and all of this extra money that has been injected into the system should be soaked up by the central bank. That is what was promised in 2008. And that is exactly what did not happen in 2008. And there's an article that I published over on the SchiffGold website today, and it was by my friend Peter Schmidt, not to be confused with Peter Schiff, Peter Schmidt. And he actually does a pretty nice timeline of the Fed's economic policy and the promises that it made leading up to 2008 and going forward. And I've talked about this before. You'll remember that Ben Bernanke, when he appeared before Congress as they began launching quantitative easing at the peak of the economic crisis, Bernanke went before Congress and he promised that this was not debt monetization. He told Congress that once the crisis had passed, the Fed would sell the bonds back, it would shrink its balance sheet, that this was a temporary measure. And it never happened. And we can go back through the timeline and we can look. It took a decade before they even started to try to think about normalizing. And when they did, it got off to a really slow start. They didn't really start in earnest until 2018. That's when we really saw the Fed begin to try to shrink its balance sheet, to try to undo all of the extraordinary monetary policy it did during the 2008 crisis. And if you recall, in the fall of 2018, we saw the stock market begin to tank. And at that time, Powell put rate increases on pause. He reversed balance sheet reduction, which at the time was on autopilot. That ended. And then in 2019, we had 3 rate cuts. And we had a shift back to quantitative easing. And if you look at the Fed's balance sheet, it was actually beginning to increase before the COVID-19 pandemic. So we were already seeing extraordinary monetary policy going into this pandemic. Of course, the pandemic has accelerated everything, and now we have unprecedented monetary policy. But the lesson here is, when Ben Bernanke was saying that this was temporary, that it was emergency, that it was crisis policy, and that it would be reversed, he was either just badly mistaken or he was lying. I'll let you guys pick which you think that is. The bottom line is, it was never able to do it. It was impossible. They had to reverse before coronavirus because the stock market was going to tank. Meanwhile, we have created this economy that is leveraged to the hilt. We have consumer debt at record levels. We have corporate debt at record levels. We had national debt at record levels even before the coronavirus pandemic. That's the result of easy money. It lets you borrow. It encourages people to borrow. People leverage to the hilt. They accumulate debt. We are now having that same type of monetary policy on hyperdrive. So everybody's, I guess, leveraging up even more, right? So we're going to have all of this debt in the system. We've got these extraordinarily low interest rates. We've got a Fed balance sheet that is now far bigger than it's ever been. What is going to happen at the point that we decide that the economy is recovering and the Federal Reserve has to normalize interest rates? That's the $64,000 question. Because if it couldn't do it after 2008, what in the hell makes anybody think they're going to be able to do it now? We have it bigger and badder than we did after 2008. They weren't able to reverse it then. It is unfathomable that they're going to be able to reverse it this time around. So what's going to happen is when we start seeing the economy recover, the first time that the Federal Reserve hints at ending the extraordinary monetary policy, the stock market is going to crash, because that stimulus is what's propping it up. All of that stimulus that Powell keeps hinting at and that the Federal Reserve keeps promising is propping up that stock market. When you start knocking those props out, when we start normalizing the economy again, you're going to see the stock market begin to tank. And if the Fed actually follows through and raises interest rates and actually shrinks its balance sheet, you're going to see a crash in the stock market like you've never seen before. Again, I'm not just speculating on this. We saw it happen already in 2018. And we already have seen that the Federal Reserve does not have the stomach to deal with the economic ramifications of raising interest rates and shrinking its balance sheet, because it can't do it in a world that is so full of debt. Imagine for a minute, we've got record levels of debt on every front. If we raise interest rates, that means all of those payments are going to go up. All of that financing is going to be choked out. And we're going to start seeing more and more bankruptcies, more and more foreclosures, more and more people that aren't able to pay their bills. You can't have a debt-riddled economy with high interest rates. Those two things do not go together. So at that point, the Federal Reserve is going to be faced with this choice. And it's an ugly choice, and it's damned if it does, and it's damned if it doesn't. Choice number one is to do what it should do, normalize interest rates, and shrink its balance sheet. But what's going to happen when interest rates start rising, you're going to see the impact of all of this debt. You're going to start seeing the foreclosures and the bankruptcies and people not being able to get the credit that they need to keep their bubble economy going. The stock market will crash, and it will be a very painful readjustment. If the Federal Reserve, when the Federal Reserve, let's say, in this scenario, when they pull back from this monetary policy, when they start to try to normalize, it will shock the economy into another recession. That's number one. Now, if the Fed does this, then it will be faced with the choice. Do we keep going? Do we suffer the pain? Do we let the stock market crash? Do we let all of the debtors deal with the ramifications of their debt in a high interest rate environment? Do we let the federal government deal with the debt that it's accumulated in a high interest rate environment? Or do we return to the easy money policy? Do we cut interest rates? Do we hold interest rates low? Do we keep all of these assets on our balance sheet and run the risk of hyperinflation and tanking the dollar? Because that's the other side of the equation. If it keeps going with this monetary policy indefinitely, we will get inflation. We already have inflation. I talked about this in a video last week. Inflation is an increase in the money supply. We have that in spades already. Whether or not it will manifest in price inflation is yet to be seen. I personally think it will. But if it keeps going, it certainly is going to manifest in price inflation. So that's the choice that the Fed is facing. It can either normalize interest rates and tank the stock market and pop all of the debt bubbles, or it can continue with the easy money policy until we actually tank and crash the dollar and create a currency crisis and destroy the dollar and deal with all of the ramifications that come with that, which could include hyperinflation, devaluing of your money, and all of the things that go along with that. So either way, I think we're in for some pretty nasty economic circumstances, no matter what the Fed does down the road. And, the question is, of course, which path will the Fed follow? I think it's most likely that they will follow the policy of let's just keep the easy money spigot on as long as we can. They're going to do that until we do have a currency crisis. That's my feeling. That is the way that the Fed has behaved in the past. It would rather prop up the stock market, prop up the bubble economy, keep inflating the air into the bubbles. It would rather do that than deal with the normalization, with the reordering of the economy that actually needs to happen, with actually allowing all of the maladjustments and misinvestments that we have in the economy to normalize. The Fed is going to keep pumping the money in. That's how I see it playing out in the long run. And like I said, this is a scenario that I don't even think is likely. I think we're more likely to see the economy continue to limp along, maybe getting a little bit of a jump as the economy opens up, but eventually rolling back over. Peter has put it this way: we'll probably move from a depression into a recession. I think it's going to be long term. And in that case, the Fed will certainly continue with the easy money policies. And again, that raises the specter of a currency crisis and high inflation. So that's kind of where I see things coming. I think it's really important for people to understand the central bank dynamics, the Federal Reserve dynamics. Most people don't pay attention to this. I spent most of my adult life being interested in politics and thinking that all that mattered was who was in the White House. All that mattered was whether the Republicans held Congress or not, and tax policy. I had no idea what the Fed was doing behind the scenes. And that is really the key. It doesn't matter so much what the government policy is. It certainly plays into things, but the Fed policy by far is the driver of the economy. And you have to understand what the Fed is doing, what it has done in the past, and understanding the fact that this was going on from 2008 forward. This is nothing new. Again, we were already seeing extraordinary monetary policy, low interest rates, quantitative easing, balance sheet expansion before the coronavirus pandemic. This was a crisis in the making. Coronavirus was the pin that popped the bubbles. I think we're in for a long, difficult road ahead. If you want to talk about how you can prepare, what you can do with your portfolio, your investments, your money, your wealth to weather the storm that's ahead, I highly recommend that you talk to a SchiffGold precious metal specialist. You can do that by calling 1-888-GOLD-160. They'll love to talk to you, let you know what options that you have. Also, you can just shoot them an email, info@schiffgold.com, and somebody will get back with you. I appreciate y'all listening, and I hope that kind of explains what's going on with the Fed. Basically, it's damned if it does, it's damned if it doesn't. You guys have a great afternoon, and I'll talk to you again soon.